Your savings account balance went up last month. You can see it. The number is higher than it was in January. So why does it feel like you're falling behind? Because you probably are. Here's the thing most people never check. The number in your account and the actual value of your savings are two different things. Your balance is just a number. What matters is what that number can buy. And if your interest rate is lower than inflation, your purchasing power, the real world value of your money, is shrinking every single month, even as the balance ticks upward. That's not a scare tactic. That's just arithmetic. Let's make it concrete. Say you have $10,000 sitting in a traditional big bank savings account paying around 0.5% annually. That's generous for a lot of major banks. Some pay far less. Now say inflation is running at 3%. Check BLS.gov for the most recent CPI figure when you're watching this, because inflation moves. But at that spread, you're effectively losing roughly 2.5 cents of real value on every dollar every year. On $10,000, that's approximately $250 in purchasing power gone annually. Not from your balance. The balance still says $10,000. But next year, that $10,000 buys what $9,750 would have bought today. The bank isn't stealing from you. Inflation is just doing what inflation does. The problem is that your money isn't keeping up, and most people never stop to check. So the first question worth asking yourself right now, do you actually know what your savings account is paying you? Not a rough guess, the exact APY, which stands for annual percentage yield, the actual rate your money earns over a year. Log in, find it. If it's under 1%, keep watching. Now, here's where people usually go one of two directions when they figure this out. Some shrug and say, fine, I'll just put my savings in the market. Some open a high-yield savings account. One of those responses makes sense. The other one can seriously hurt you. We'll come back to that. Let's talk about the high-yield savings account first, because there's a lot of confusion about what it actually is. Most people hear high yield and assume it's something complicated, an investment product maybe, or something with fine print that exposes your money to risk. It isn't. A high-yield savings account is a deposit account. That's it. Same category of product as what you already have. The meaningful difference is that online banks, which don't carry the overhead of thousands of physical branches, can afford to pass more of their earnings back to depositors, so they pay significantly more interest. In recent years, accounts at online banks have paid APYs roughly 8 to 20 times higher than the national average for traditional savings accounts. Those rates move with Federal Reserve policy, so check bankrate.com or nerdwallet.com to see what's competitive right now. Specific rates change frequently enough that any number cited here could already be outdated. And the insurance? Identical. FDIC insured online banks carry the same federal protection as your current bank. Up to $250,000 per depositor, per institution, per ownership category. Your principal is protected the same way. The returns are variable, meaning the rate can and will change as monetary policy shifts. But the money itself is just as safe. So what's the catch? There isn't a dramatic one. The rate can drop. When the Fed cuts rates, high-yield accounts follow. Your money doesn't grow at a fixed rate forever. But earning something meaningfully higher than near zero is genuinely better than the alternative. And the barrier to switching is paperwork, not risk. You're probably wondering, so why doesn't everyone just do this? Mostly habit, brand loyalty to a bank you've had since college, the minor friction of opening a new account. People don't think about their savings account as a decision they're actively making, but leaving your money somewhere that's paying you almost nothing is a decision too. It just feels invisible. Now, here's where the real nuance lives, And this is where people make mistakes that actually cost them money in a serious way. Not all of your savings should go to the same place. The right move depends entirely on the time horizon of the money, meaning when do you actually need it? Money you need within the next 1 to 2 years? Your emergency fund, a down payment you're saving toward, a trip, a car, anything with a concrete near-term need. That money belongs in a safe, liquid account. An FDIC-insured high-yield savings account is the appropriate vehicle. It earns competitive interest, you can access it when you need it, and it won't drop 30% in value 3 weeks before you need it. That last part is critical. A standard guideline is to keep 3 to 6 months of living expenses in an emergency fund, enough to cover a job loss, a medical bill, an unexpected repair without going into debt. That money needs to be accessible and protected, not chasing returns. Money you won't need for 5 or more years is in a completely different category. That money can reasonably be considered for long-term investment vehicles, retirement accounts, broadly diversified index funds, instruments designed to grow over time. The S&P 500 has returned roughly 10% annually before inflation over long periods, though past performance does not guarantee future results. And that growth comes with real volatility in the short term. That volatility is acceptable when you have 5, 10, 20 years to ride it out. The error, and it's one of the most common and costly errors in personal finance, is mixing these two up in either direction. Keeping money in cash that you genuinely won't need for a decade costs you. The math compounds in the wrong direction. 10 years of meaningful inflation on $20,000 in a low-yield account is not a small number. But putting your emergency fund in the market? That's the other mistake, and it's arguably worse in the short term. An emergency fund exists for one reason: to be there unconditionally when something goes wrong. If that money is invested and the market is down 25% the month you need it, you're either selling at a loss or going into debt. You've turned your safety net into a gamble, even if it didn't feel like one. So when people say, "I'll just invest my savings to beat inflation," the question you have to ask first is, which savings? Short-term, needed within 2 years money should never be in the market. Long-term money that will sit for many years probably shouldn't be sitting in cash either. Here's a simple framework. 3 buckets. 1 is for money you need available right now, that lives in a checking account or regular savings. 1 is for your emergency fund and near-term goals. That lives in a high-yield savings account, FDIC insured, earning competitive interest without market exposure. 1 is for money you genuinely won't touch for 5 or more years. That's where you think about investment accounts, retirement contributions, and long-term growth. The goal is to have each dollar in the right bucket, not all in one place. The reason this matters is compounding. When your money is in the wrong place, the cost accumulates quietly over years. Roughly $250 in lost purchasing power per year on $10,000 doesn't sound catastrophic today. But that's approximately $2,500 over a decade before accounting for the compounding effect of the gap. And most people don't have just $10,000 sitting in a low-yield account. They have more, and they've been there for years. You can't control inflation. You can control whether your money is positioned to keep up with it as well as possible given the risk constraints your timeline actually requires. 2 things worth doing this week. First, look up the actual APY on your savings account. Log in, find the number. If it's under 1%, search for current high-yield savings account rates on bankrate.com or nerdwallet.com. Opening one takes about 15 minutes of paperwork. Second, think about what that money is actually for and when you'll need it. That time horizon should determine where it lives. Your balance going up is not the same thing as your money getting stronger. One number you can see. The other takes a minute to calculate. That calculation is worth your time. If this changed how you think about your money, there's more where it came from.